WCLN 1170 Radio and Cable Channel 16 are pleased to present We Should Know, hosted by J.W. Simmons, an upbeat, informative look at people, places, and issues facing our community. This education-based analysis of issues will remain positive and informative as we consider closely what we should know.
Ladies and gentlemen, welcome back. We Should Know's on there. I want to thank you for being with us today. Tuesday, each and every Tuesday at 2:30, we come to you bringing you information, hopefully some education that'll help you not only get through the day, but the week, the month, maybe the next year. The situation we're in now, we're kind of ramping up a lot of our information around impacts related to COVID-19. I know you get inundated with that. Some of the things that we bring to you is not typically what you hear a lot on the mainstream programs. We're trying to kind of, I guess, catalog some of this stuff where you can look at it more in a sense of other things happening related to the physical health side. And one of those people that deals with analytics and numbers a lot is Michael Chestnutt. Michael's a graduate of East Carolina University, Bachelor of Science in accountancy, and also a certified public accountant, accredited business evaluation person, registered investment advisor, certified financial planner. Michael, thank you for taking time to be with us today. Got a lot of stuff to talk about.
There's certainly plenty to talk about right now. I mean, obviously we got tremendous uncertainty out there, so.
Well, I want to kind of open this morning and I guess get your kind of overall 20,000 foot level. We literally have been inundated on a daily, if not almost hourly basis with numbers about tracing, with numbers of people that's been infected with COVID-19, the running charts on flattening the curve. We all remember that for the past 2.5 months. We've seen everybody from Dr. Fauci on to Dr. Cohen here in the state talking about that curve. But while all that's going on in the world of analytics, in the world that you operate in numbers and finances and businesses and that kind of thing, those numbers have been doing some really crazy stuff as well. And a lot of that is a lot of people's worried about because their money is being crashed.
Yeah, I mean, if you look at it, obviously, you know, health and finance intersects for us in society. I mean, when you look at it, we were going into the COVID epidemic at, you know, historically low unemployment numbers. And when you look at it, I mean, wages were growing. We were clipping along fairly well economically. And when you ask the country to essentially shut down for a health crisis, I mean, there's some intended and unintended consequences. And certainly one of the things that we all thought, you know, would happen is it would adversely impact financial markets and unemployment. I don't know that anyone really predicted it would get to Great Depression era type unemployment numbers. The difference, you know, between this and the Great Depression is this was, you know, mostly self-imposed, and, you know, the theory, you know, hopefully if we do this in a structured way, that we could come out in a structured way and we would have a V-shaped recovery. Every day that goes by, it's appearing that that's most likely not going to be the outcome of this. And you see a lot of it from the standpoint of how states and localities are, you know, certainly not in a unified fashion starting back their local economies, and you have a fractured approach to it. And so we'll have fits and starts where we'll have some places that are starting back. You go to South Carolina and Georgia, they're ahead of what we are in North Carolina. And structurally, you would expect there to be differences in terms of what their economic impacts will be versus ours. So I think when you look at that on a macro level for things like what it's done to your portfolio, it's hard to see how we will not have ups and downs in the financial markets for some time to come. I mean, when I sit there and every day I read for probably at least an hour, one of the most recurring themes I see is we will have longer term, higher unemployment coming out of this just because it's going to take us some time to get over what we're going through.
A lot of, I think, of what we all see to some degree is these ups and downs in everything from the grocery store to not being able to find toilet paper to all of a sudden the meat counters may be a little less than they were before. Some prices are going up, some prices are going down. Is everything that is happening somehow a violation of a system that has been broken because of COVID-19? We've actually shut down a system of events. Is that part of it? And the financial system itself has been interrupted?
It certainly has been interrupted, but you take things like meat, and I think you said you were going to have someone later that would talk about what's going on in the farming sector. This is not a demand-driven problem or a recession that we're dealing with right now. You have situations where you have outbreaks that may adversely impact, like packing plants. You've got to shut a plant down. I have at least 3 clients that I know of that have market risk on animals in our area. The state, obviously, contract farming is a big deal, but we still have some that have market risk. They're not able to sell their commodity, and they're having to euthanize animals because they can't get the next part of the process to take their animal and go ahead and carry it on through because they can't get people in their plants not functional. So it's not that the customer doesn't want the meat, it's that there's an interruption somewhere in the supply chain that you're just not able to push your product through to the next stage. And so you're going to have real winners in this process, and you're going to have real losers. I mean, if you just look locally, I mean, go to Lowe's, it's wide open all the time, So we've, in some capacity, we've picked winners and losers in this process. And I'm not certainly one that necessarily wants to try to pick who the essential businesses are, but it's hard for me to understand why providing a tax return, which is my primary livelihood, is an essential business, but some others aren't. And so, I mean, it leaves you scratching your head. So I expect disruptions that will impact us for 6 to 9 more months, just because, again, you take LA County in California, they've extended their lockdown through July. LA is an international hub. I don't see how you would say, as a North Carolina citizen, that's not going to impact me, but that's folly, because what they do impacts us, because I mean we're kind of all in this thing together, and I just expect longer term problems as a result.
A lot of what we're seeing too is this large divide that seems to be occurring more and more, in which you have a group, as you just mentioned, that maybe says, well, look, I'm ready to go to work, I'm ready to do some things, why can't I get back? The medical folks keep telling us we're losing lives if we jump back in too quick. Even some stuff out recently, some of the experts are saying we may have one of the worst winters that has been seen by modern man. And it causes this innate fear. When you're advising businesses and people that are in the $1 million bracket in business, what do you tell them about their money? What do you tell them about, well, go ahead and build that other building, or go ahead and take on that other project? Is it just an unknown world, or does the analytics telling you something that maybe we're not seeing?
Well, I mean, certainly, I mean, you want to go into a situation where you have decent financial health, whether it's personally or whether it's in business or whatever. So, I mean, from the standpoint, I try to get people to at least go into a process and have at least some, money or resources that they can fall back on in hard times, and not necessarily have to run to the lender as your first line, and certainly not have to wait on the government for something that may be a bailout. So I do think the average person probably has a misunderstanding as to what a small business owner truly does have. Most small business owners aren't sitting there with 6 to 12 months worth of cash available on hand to weather a storm like this. And so, would I advise someone right now, you can't make a global blanket statement that you want to sit there and say, capitalize on this opportunity. I think everything is going to be okay. A wish is probably not a great idea from a business planning standpoint. I think you have to look out, and certain industries are clearly going to do better than others, and I think you have to take it on a case-by-case basis as to what they're going to do.
We often see our government leaders and others making pronouncements about things and what we need to do and what we don't need to do. Quite often, one of the things that tends to bother a lot of folks, and when you look at the U.S. Treasury website, you can see this. We're looking at a $25 trillion right now debt without adding a lot on to it. Yeah. As we start adding on to that, and this probably question is going to go into through the break and into our next segment, but when we add on to that, we keep seeing the uptick of that, and we see something called the gross national product or GDP or whatever. All of these kinds of things is somewhat confusing to folks. Is there somewhere, like just in a regular home budget, that our national budget needs to balance If not, we're going to be, as oftentimes I've heard people say in the car business, you get upside down in a car.
Right.
Well, I mean, I know that's oversimplifying it, but is it possible that the federal government, I can't even imagine $25 trillion, but is it possible that we could get upside down?
Well, it depends on what your measurement would be, whether we're upside down. I mean, right now, the country's in the ditch, and so we feel like we probably need to spend some resources to make sure we don't have longer-term structural problems. In terms of debt of the country, $25 trillion is a big deal. We have a vested interest in trying to reduce the trajectory of that debt long term, because at some point in time, interest on that debt, if it were to return to what a normalized interest pattern would be something that would be very detrimental to us long term. And so when you look at it, we almost have a vested interest in keeping interest rates low longer, just because if interest rates do go up, it impacts what we have to service on our own debt. So when you look at it, that impacts things like savers. And so when you look at it, just less than a year ago, you were probably in a large deposit base around here is at the State Employees Credit Union. Mm-hmm. You could get anywhere from 1 3/4 to 2%, mm-hmm. and that would be sitting in a money market account. Mm-hmm. Today, you're going to be doing lucky if you got, say, 70 basis points as your interest rate. And so it has real-time impacts, real-world impacts on savers. And so when you look at it, it's something that could be a problem, is a problem, and we've got to do something about curve and trajectory, whether it's increasing taxes on some folks. No one wants to hear that. Whether we cut spending, beneficiaries don't want to hear that, or a combination of both, but clearly something has to happen, because we can't continue on the present path that we're on, not indefinitely.
We want to continue this discussion when we come back from break. We're going to take a quick break, and folks, we're going to ask you to stay with us. We're talking about your dollar, your money, your responsibility. We might be talking about $25 trillion the U.S. government owes, but it's your money. Call our friends, stay tuned. We'll be back in a moment.
Experiencing slow internet? If you have a fast internet package, the problem is most likely your wireless router. With more devices using Wi-Fi, your wireless router may not be able to deliver the speed and coverage you need. We now have the leading solution to enhance your internet experience. Using small devices in a mesh network, these Wi-Fi appliances cover just about any size home, so that all your devices can operate to their fullest potential. Whole home Wi-Fi from Star Communications. Get the most out of your internet connection.
Ladies and gentlemen, welcome back. Thank you for being with us. We Should Know is on the air each and every week. We come to you 2:30 on Tuesdays. Also, there's a replay of this program on Tuesday, Thursday, each Tuesday, Thursday at 7 p.m. You can pick us up on Star Communications Channel 16. Of course, we're on Star Communications Channel 16 on Tuesday, as well as WCLN Radio. There's a summation of the Sampson Weekly newspaper, and you can continue to reach us by just simply sending us an email to weshouldknowedu@gmail.com, weshouldknowedu@gmail.com, or if you'd like to just send us a little post note there to the U.S. Post Office, you can send it to Post Office Box 1482, Clinton, North Carolina, Post Office Box 1482, Clinton, North Carolina. Just send it to We Should Know. We're talking with Michael Chestnutt this morning. Michael has been around for some time here now. He is employed with his own agency there. He's a shareholder at Black, Chestnutt, and Johnson, PA in Clinton. Provides services and the tax services and everything from that to business valuations to registered investment advisor. You've been on a number of boards. You currently serve on the Southern Bank and Trust Company Board of Directors. Mike, before you came on this morning, we were talking earlier. You've literally been on just about every board and civic club I can think, and chaired everything from Rotary clubs, been involved with Kiwanis clubs, and Sampson Community College. You've chaired their board of trustees. For a young guy, you've got a lot of footprints around everywhere. I want to thank you for being with us. As we went off air, we were talking a little about this thing about GDP, and we were talking about the debt. Tell us who owns that $25 trillion debt.
Well, thanks for calling me a young guy. At 52, I don't feel that young any longer. But when you look at it and you hear all the time about foreign ownership of our debt, and that's partially true. But our debt is it's kind of a complicated pie chart if you were to look at it. about 25% of our national debt is actually owned by intra-agency, if you will, amongst the government. So the federal government itself, whether it's the Social Security Trust Fund or some other agency or whatever, about 25% of that, $25 trillion, is going to be owned by the government itself. And so really that you need to reduce and lop that number off when you're looking at total headline debt, because it's like you're swapping it from one savings account to another or one pocket to the other. When you look at outside debt, meaning foreign ownership of our debt, 29, 30%, somewhere in that range is what is owned by foreign countries, whether it be Great Britain, whether it be Australia, whether it be China, or whatever. And China is the boogeyman, and certainly they have had some situations where we may have had some disagreements, and I'm certainly not a China apologist, but I think when you look at it, it makes great headlines from the standpoint of China being the boogeyman in the room. But China's actually not the biggest foreign holder of U.S. debt. It's actually Japan. So Japan actually owns about $300 billion more of U.S. debt than what China owns. But China is the bad guy in the room, right now, and has been for some time. And so when you look at it, they have a vested interest in seeing the United States be prosperous as well, because it would adversely impact them. I know we've been fighting about trade, and they certainly have been bad actors when it comes to trade and fair trade in terms of dealing with them in the past. Hopefully we're getting some of those things addressed. You won't get them all addressed at one time. But if they don't have a prosperous U.S., they can't export their wares to us, and they're a net exporting country from the standpoint of things like that. So they need us to have a prosperous situation, because if we can't buy their goods, it's not good for them as well.
So we're really talking about dependency here. We're literally dependent on each other. It is.
It's a codependent situation. If I had to pick what I think would be one macro trend out of this, I had no idea that as many pharmaceutical drugs in our country were made in China. When you look at the percentage of antibiotics and generic drugs and things like that are made in China, it's actually, from a strategic standpoint, it's quite scary. And so I expect some resource or reshoring of some of those manufacturing, specifically strategic manufacturing. I think that will come back to this country in some capacity, and I think that's a macro trend that probably is durable, and I wouldn't say permanent, because nothing's ever really permanent, but that may in and of itself lead to inflation, because people go to China, people go to India, people go to emerging market economies really for one reason: less regulation and cheaper labor. And so, as we start to put structurally in place some things, and I would expect they would be derelict in their duty if they didn't address some of the strategic problems with having some of these things that are outside the country brought back to this country, which will lead to one thing. I think we're going to have medical inflation as it relates to that, because if you had someone making $1 an hour versus $25 an hour, and labor is one of your biggest components in your manufacturing cost, you would logically expect the cost of those products to go up. And so I think there's going to be, out of this, there's going to be a reaction that we want some of those jobs to come back, at least to more friendly confines, where we're not threatened when we end up in an adverse situation like this, that, hey, we'll hold the drugs from you if we want to get adversarial.
Mm-hmm. So when we look at the debt ratio situations, and you look at other countries, is where we are with our debt load now, is that kind of the norm throughout with other countries? Are they in debt as well, or basically are we just borrowing money from all these other countries that you just mentioned, and we're kind of as the old saying goes, we're kind of upside down on our car deal here, and it doesn't seem to be going away. It just seems to be growing. Because I remember when there was a lot of chatter about a $15 trillion debt, and now we're 25 plus. This is as of yesterday, the 12th, 25 trillion plus, and I suspect it's going to continue to go up.
I would say most mature industrialized economies have a sizable amount of debt. The question is, how much debt is too much? I mean, you had mentioned, about the gross domestic product. That's the value of all goods and services that we produce in one year. We now have more debt. When you look at total headline debt, that's not what's stripping away the part that we owe to ourselves. But when you look at total debt, we're now at a greater debt number than essentially what we have income. If you put that on a personal basis, think about your house. Your house is generally your biggest asset. Most people probably have a house that's worth more, or maybe they owe more on a house than what they would make annually. And so don't necessarily get confused about income and debt. You need cash flow to service debt. And right now, when you look at it, what we have is a situation, and we've been doing this for some time, and this is probably the easiest way to look at it. You had started, I guess, the dialogue earlier about how this would impact individuals and finances and such.
Who owns it right down to the individual?
Yeah, but an individual, if you think about it, if I bring in $50,000 and I pay out $60,000, I have to make up that $10,000 of deficit through somewhere else. And that either comes from savings, it either comes from a loan,
part-time job or something.
Whatever. And so as a country, we have to do the same thing. And so from that standpoint, the real question is, with the existing tax revenues that we bring in as a country and the existing spending that we have on education, on security, on interest on the debt, on all these social entitlement programs, does that number exceed what we bring in revenues? If it does not, then you have what's called a deficit. A deficit basically means you spent more than you brought in. The difference between you and I, we have to go to Bill Scott and borrow the money if we don't have it, or transfer it from a savings account. Federal government gets to write an IOU. That's when they issue treasury obligations, and that's when, whether it's China or Japan or retail investors, mom and pops, pension funds, things like that, they either decide they want to buy it or they don't want to buy it. Okay,
right,
but that's how we're essentially financing that. So deficits, annual deficits, become debt, and so that's where we're at. And one begets the other, and so the more debt you have, the more interest on the debt you have, and it could drive up your deficit. So it's kind of a self-fulfilling prophecy where you just keep capitalizing. Deficit spending becomes greater and greater debt. So at some point in time, one of two things or both has got to happen. We've got to increase revenues or reduce expenses, or a combination of both.
And the conversation with increasing that revenue is where it gets really tricky, because as you mentioned, in fact, we were talking off air a bit about where does that come from? Do we increase taxes? Do we look at folks and say, well, look, we got to make some significant changes to Social Security and Medicare and all these kinds of things? Any one of those triggers unbelievable outrage from the public. How do we approach this? It's almost impossible to relate it to your personal income, but I think you've done a good job doing that. So with my personal income, does that mean then I need to go out and get another job? Where am I going to get this revenue from? How do we approach that? Because none of the political leaders really want to come in and say, we're going to increase your taxes. Well, some of them may, but for the most part, a lot of them don't. And nobody really wants to touch Social Security and Medicare, which a lot of people says is a big chunk. From where you sit, from a strategy point, what would you say to people in leadership? What should we do?
Well, sometimes you have to eat your peas and carrots. I mean, if you expect, if I had to give one piece of advice to the ones that would listen, and most of them aren't. I mean, whether you're a Republican or a Democrat or whatever, I think your first priority, if you're honest, is to get reelected. Okay. After that, they may have our best interest in heart. I hate to paint them with such a broad brush, but you look at all the political infighting right now, and it's not very helpful.
It's the nature of the job, kind of.
But my one piece of advice is they're never going to get one group to bear the brunt or all of the burden. And it's going to have to be a shared proportional response. Now, the question is, how do you get both parties to realize that each one of them need to have some skin in the game? You have, a tremendous number of people in this country that think about income inequality, and we certainly have income inequality. You're not going to address it overnight. You're not going to have one fix that's going to handle it all, but they just need to expect both sides are going to have to give some.
We're going to continue this when we come back from our break, and I want to kind of get into some more particular detailed subjects that we can talk about a little bit, but there's so much involved in this. We're really trying to take a semester here. Ladies and gentlemen, stay tuned. We'll be back in a moment. Call a friend. We're talking about finances. Maybe it can help you better understand what's going on and maybe adjust your budget a little.
You come out to replace a bad sensor, and that has a 5-year commitment to my contract, and you don't tell me? Here's your sign.
Switch to the sign that's keeping homes secure and customers happy all over the area. Security from Star Communications. We pride ourselves on fair pricing and quick, friendly service every time.
Somebody trying to break into this place?
Security from Star Communications.
Ladies and gentlemen, welcome back. Thank you for being with us. We Should Know is on the air. We're coming to you from Star Communications Channel 16. It's also aired on WCLN Radio every Tuesday at 2:30. The summation in the Samson Weekly newspaper as well. We're talking about finances, analytics as it relates to COVID on the financial world. Michael Chestnutt's with us. Michael's got an extensive background, certified public accountant. He's a registered advisor, certified financial planner. Michael, you got a lot of titles. You've been involved in this business for some time. You got a lot of clients that look to you for direction. And they call you, I'm sure, and say, what do you recommend I do here? Or I need to buy this. Is now a good time? For the person, individual out there that's listening to us, and we're half through with the show, so I'm going to kind of, I guess, move some of my stuff around a little bit here. But help us understand, and I'm going to put myself, I'm in that same situation, I'm the average guy. Help us understand what, if anything, we can do now. Do we just kind of adjust and prepare and listen and say, let's hold on. What do we need to be doing? If anything, is there anything we can do? I mean, because on one side, every day we're inundated with the idea of put our mask on, go to the grocery store, get the essentials, go back home, and don't leave. Yeah. Even though we're now in phase 1 of the recovery plan, and hopefully soon we'll be in phase 2, but what is that doing to us, and is this to help? What I'm trying to do is see if we can build a bridge here with the folks that says we're not going to do it, and the folks that says, well, you need to keep doing it. Where's that bridge?
Yeah, I think it really is a function of what aspect of your financial life you're talking about. If you're talking about for an average person out there that's 20, 30, 40 years of age, what should they do? Probably very little. You've got a situation where if you're still getting, let's say you're lucky enough to work for a company that you're still getting a paycheck, or if you work for a company that got one of the PPP loans and they're able to continue to pay you, maybe you didn't see any disruptions in your monthly income. Certainly for those folks, if you're not needing like retirement assets right away, then you really don't need to change structurally anything that you were doing. It is unhealthy, it is unfortunate, but turning on the 6:30 news and being scared to death will make you do adverse things when it comes to your long-term financial health, when it comes to like portfolio management. One of the worst things I see people do is to get scared and make long-term structural decisions that'll impact what their portfolio will be long-term, because if you're self-employed or if you work for a company that doesn't offer a pension, then you have to set aside some for yourself. And so if you're that person in the 20s, 30s, 40s again, this is the Kmart blue light special. You're getting the opportunity to buy things on sale, and so you continue to contribute to the market every month. You dollar cost average when things are lower. To not think that we won't find a vaccine and to not think that we won't be better than where we are financially a year from now or 5 years from now or 20 years from now has been proven time and time and time again to be wrong. This will be a momentary blip in history, and when you plot it on a chart, although we backed up 25, 30% in terms of what the financial markets would have done, long term the trend is up. And so you need to be prepared, and being prepared for inflation in the future, and the only real way to do that is to take more risk with your money. And so if you're younger, you're afforded the opportunity to have time on your side and take more risk. If you're older, you're afforded less of that opportunity. Rarely do I ever want to see someone go to more than 50-50 between being in risk-based assets and being in non-risky assets, things cash, CDs, things like that. And the reason why I want at least half of it in equities is because that's a piece that's going to give you a possibility to exceed inflation, and you're going to need that later on in life, especially as we start reshoring things into this country and we're guaranteed to have inflation. You keep talking about how much debt we have. At some point in time, it's going to require us to raise costs to pay that debt back, and so you've got to have something that's going to exceed what you're going to get at BB&T or the credit union or things like that. In terms of, if you're just a net saver, unless you're an extremely thrifty person, that's probably not going to take you to the promised land, and you're going to have a part-time job until you die.
Yeah, that and Social Security just ain't going to keep the lights on.
Yep.
Well, and you mentioned pensions. I want to touch on that. Dale Falwell, State Treasurer, just recently, of course, he said this over and over again, is that the state treasury itself is in great shape. We're one, I believe he said, one of 5 states, the top ranked states. Right. That sounds great, but over time, is it easy to consider that over time that could also deplete, and we could be looking at some sense of concern for state retirees and others?
I don't think right away, if we end up with long-term systemic structural problems that
we're talking years.
Yeah, years and years and years. One short-term event is not by itself going to cause us a problem, but a decade of this, we all have problems. And so I don't think pensions, public pensions to a lesser extent, because they obviously have the ability to increase taxes and things like that on its constituents. But when you look at private pensions, they could be at risk, and it's not rocket science how these things are funded. I mean, they sit there and look at the number of participants, the average age, how long they think they're going to have to pay out these beneficiaries, and they extrapolate what expected returns are going to be. As returns come down, companies either have to put more money aside or they reduce benefits one way or the other, and so it ends up being an undue strain on businesses if the economy and interest rates and returns are low, because they have to end up funding more money as an economic cost to make up for that defined benefit pension plan that they promised someone.
You've got a broad range of clients. Do you ever get clients to bring in information, lay it out in front of you, and say, you know, I'm fixing to buy, I don't know, $500,000, $1 million, whatever, because a lot of ag stuff now is high dollar. Do you ever look at them and go, I don't think I would advise you to move in that direction at the present time?
I tell you, the ag sector in particular, unless you're in certain segments of ag, I would think your expansion mode right now is probably not going to happen. When you look at it, commodity prices have been historically low. Most people don't realize last year, 44%, I think it was, of farm income nationally, not just for us locally, came from crop insurance, government payments, or some sort of one-time payment from the Trump administration. And so when you look at it, you know, and we feel that locally more so than most other places in the state, but farm incomes have been under pressure. And again, you don't have to drive too far down 421, and I'm sure there's a gentleman down there that can tell you he's got a lot of pressure on him.
Absolutely.
And I'm rooting for him every day, because we need local entrepreneurial-minded like that, people like that have continually given back to us locally from the standpoint of good paying jobs, an opportunity to be self-employed, and to expand and do things that you wouldn't have the opportunity to do otherwise.
Well, and you mentioned that, and I think the integrators in the farm operations now, those people years ago opened the door to possibilities that just average people would never have experienced had that not been there. And they plugged into a multi-billion-dollar industry. Yeah. So with that said, you also then reflect, and there's those folks that are, as you mentioned a while ago, in their 60s, and they're looking at, well, what do I do? Because my financial advisor just said, look, your $1 million account now is down to $400,000 or $600,000. Well, a lot of people say, oh, that's I wish I had that much money. But if you do the interest rate earn back on it, you're not really, as you said, you barely can get by and make if you're making a house payment, hopefully you're not, but if you are, you can make the house payment or the rent payment, and beyond that, you got Social Security. So, and there's not that many people that have that asset value.
Yeah. Yeah, the one thing I would make sure folks, we're going to have one thing that comes out of it. This may be our version of the Great Depression in terms of how people will process this and how they'll change their financial life. That's not necessarily a bad thing. If you look, generally speaking, our economy is built not necessarily on equity, but on debt a lot of times. I mean, you think about when you go buy a car, most cars are financed. When you go buy a house, most houses are financed. If you can pay cash for it, that's great. But this could be something where financially, we're given the opportunity to be more net savers. The problem with that, though, is if we all collectively decided we were going to be net savers and not spend as much money as we had in the past, think of the detrimental impact that would be on society, because if I'm not going to go to Best Buy and buy me a new gizmo gadget, whatever they have over there that I'm buying, then I've taken money out of the economy and I put it in the bank account. So it's contractionary to the economy when you take and pay off debt or when you start saving. None of those things are bad, but if we all simultaneously start to do it at the same time, it would be bad overall economically, bad for the stock market. Companies would have to start funding more in terms of dollars into pension plans, things like that. And so, I do see a psychological shift. If I had to predict something would happen, I think that is going to be one of the trends. But the long-term thing that I would try to get people to do is take this situation, if you're afforded the opportunity, try to build your own war chest where you're not waiting on a government bailout, whether you've got your own funds to help you weather the next storm. Then as that translates into, if you have other things that you can invest and look at, never put any money in the stock market if you need it within 5 years. I don't care how good of a stock picker you are, don't do it. Take that money, set it aside, put it in a savings account. Break your money into buckets, risk-based buckets, non-risk-based buckets. And the non-risk-based buckets is your rainy day fund. If you need money in the next 5 years, don't put it in equities.
We want to continue this. We're coming up on our break, last segment coming up. Ladies and gentlemen, stay tuned. Our last segment, I'm going to try to do kind of a takeaway time, give Michael an opportunity to tell us what we need to do.
To get the most out of your electronic devices, you need a strong internet connection and a protected home Wi-Fi network. You need high-speed internet from Star. Star has the fastest, most affordable high-speed internet service available for all your devices. We have no long-term contracts or high-pressure sales. Our service speaks for itself, and switching is hassle-free. We take care of everything with free installation from a local company. High-speed internet from Star. Internet at the speed of life.
Ladies and gentlemen, welcome back. We're coming up on our last segment. We Should Know is on there. I want to thank you for being with us today. We've been talking to Michael Chestnutt. Hopefully you've gotten the first segment. Remember, you can see this each and every week at 2:30, and it comes live to you on the radio and on the TV and in the newspaper. Also, there's a replay at 7 p.m. Tuesday, Thursday on Channel 16 Star Communications. So if you happen to miss it, you can record it, play it back later. Michael, as we were talking and we're going to break, again, we've taken what could easily be a semester course here and tried to compress it into 50 minutes. So I just want folks to understand there's a list of things here that I wanted to talk to you about, and some of them I'm not going to be able to get to. So I want to try to take the opportunity with this last segment for you to continue with what you were doing in the previous segment at the last there, just talking about things, and we could call them takeaways or things for consideration when it comes to individuals. Again, depending on where you are, whether you're 65 and living off your pension, whether you're 40 or 30, age and ability and skill set has a lot to do with it. I'm constantly battering my grandchildren. Well, you need to do this, and you don't need to wait till you're 20 to do it. And sometimes I'm told, you just need to be quiet. I can't, But help us, kind of give us some of those things now, and I'll call it kind of the down and dirty, or where we are and where we could be. Well,
certainly you end up having to make some of your own mistakes in life to figure out My mother had a different way of saying it. I won't say it on the air, but sometimes you have to step in it to believe it. I think was
absolutely.
But no, to kind of finish up, I guess the thought we were going to break on is, if you think about, let's just use a hypothetical example. I have $100,000 in my retirement account, and I'm 40 years of age. Is that enough? I mean, that's a whole different discussion. But the real question is, do you need those funds today? And this really is whether it's in a taxable account, it's just a personal savings, or whether it's in a retirement account, the approach should be the same. If I break that into buckets where funds I may need in the next 5 years, funds I'm most likely not going to need in the next, because no one can make a wholesale statement most of the time that they're not going to need it in the next 5 years. But if you can most likely say I'm not going to need these portion of my funds in the next 5 years, then if I were to give you an assurance that 90% of the time you're going to get all your money back in the next 5 years, that's a pretty good assurance. Mm-hmm. If I were to give you an assurance in the next 15 years, for every rolling 15 years since the Great Depression, 100% of the time you got your money back. And if you left it in there and let it work for you, you will make many times more than what you would have in a safe investment. Mm-hmm. I think people would approach it from the standpoint of not making structural, long-term, detrimental decisions to their portfolio. And so if I'm 40 years of age with $100,000 in my retirement account or in a taxable account, assuming I've got the rainy day fund already taken care of, I should approach that differently than I should if I'm scared and I'm going to run down to the credit union. Again, if you're going to put it, there's nothing wrong with net savings and putting funds in certain traditionally viewed as safe assets. But again, those safe assets aren't necessarily immune from the downturn. Again, interest rates going from 1.75 down to 0.7% at the credit union, for instance. But long term, you can do much better than that if you're willing to take a little greater risk, on your money. Now, the closer you get to retirement age, you start dialing back the amount of risk you're willing to take. But the younger you are, the more risky strategy is to be too conservative. The older you are, the more risky strategy is to be too aggressive. And you've got to constantly adjust your personal financial plan. Long term, one of the best things you can do is set yourself up on a monthly contribution or a savings plan that you're going to do, whether it's through your company in a 401k or a simple IRA, or going down to the bank and contributing to an IRA on a set amount or a withdrawal out of your bank account. The more you put things like that on autopilot, the psychology of it becomes easier, and that's what you have to do, or you end up, torpedoing yourself. Turn on the 6:30 news will lead you to a bad decision almost every time, because whether it's Fox News or CNN or the ABC World News Tonight, they don't lead with the happy story. Mm-mm. They lead with the story that's to scare you.
The train wreck is what they want.
And those things are by design. They want to get you hooked so they can get you to the commercial, which is where they make their money. Absolutely. And so tune the noise out. You will do long-term damage with poor short-term decisions, and you will not time the market. If you do, you will only do it for a short period of time. You will not do it for a long period of time. And so continue to be in, continue to dollar cost average, and do not shoot yourself in the foot. If there's one thing an advisor should do for you, if he tells you, I'm going to beat the market, you need to run, okay? His goal should be to educate you, to make sure you don't take your own gun and shoot your own foot. Mm-hmm. If he's done that, he or she has done that, they've done their job. They need to keep you on. We've all seen the Fidelity commercial, probably one of the most ingenious commercials of all time. Stay on the green line. Stay on the green line.
Exactly.
When you get off the line, you mess up.
It's a simple analogy.
It is. It really is, one you can understand. But I'm not telling you not to look at your statements when they come, but don't make rash decisions based on short-term anomalies. Again, if you don't think that we'll be better off 5 years from now, 10 years from now, 20 years from now, I think you're wrong if you think that way. And because we've proven it time and time again that we'll either come up with a vaccine or something will change, technology will happen. If you don't think things will change, ask BlackBerry. Apple kicked their tail, and somebody was going to kick Apple's tail one day. I just don't know who it's going to be.
It's the next paradigm shift.
That's right. Somebody's going to eat your lunch. I want to be in the game to at least get a bite at the apple. And if you're on the sidelines, you can't participate.
We look at this thing, Michael, as a world pandemic. So when we look at the United States being a capitalistic environment, and we look at other countries that don't necessarily have this kind of ability of ebb and flow that we deal with, are we in a better position in a pandemic to be in a capitalistic environment?
Well, pure capitalism is not necessarily great. Pure socialism is certainly not great. We have a pseudo-capitalistic society. If you really look at it, what have we done here lately? Yep. We've socialized losses in the fact that, businesses are struggling, here's a PPP loan, you may have it forgiven, here's a grant, here's something else. And so to some extent, we've insured losses. And so we have a managed economy. If you look at it, one of the things you probably have heard about is things like negative interest rates, yeah. Okay? If you look at it, the reason why our interest rates have been higher is because we've been the best house in a bad neighborhood, okay? And so when you look at negative interest rates, those economies are not the economies you necessarily want to emulate. The one thing I try to tell folks, socialism is a great concept, but it fails on one human principle: psychology. Okay, if you're going to do the same thing that I am, we're going to make the same amount of money, or my efforts. I'm going to change how I'm going to approach things. And so, if you expect me to do more and make the same, it fails on the psychological front.
It removes the opportunity.
Yeah, you can't make my benevolence be compulsory. It's at the butt of a gun. Is not how that works. And so pure capitalism, we're not ready for that, because you're a winner, you're a loser, you go on into your corner and you take care of yourself. Yeah. And we're not there. We haven't been there for a long, long time. Think Social Security.
Right, exactly.
It was created out of thin air for people
for that purpose.
That had never contributed to it. Not saying it's a bad program, but we have that as at least some sort of social safety net. And so again, we're not purely capitalist. I hope we never become purely socialist. The main thing is because I don't think we could afford it.
And the balance is where we're at, and that balance will work, as you just pointed out, to restate that, if you stay on the wagon and don't jump off.
The one thing you need to do is personal responsibility as much as anything. I would go out of my way to try to make sure I could take care of myself. If I had to rely on some assistance, then that's just an added benefit. Sometimes people aren't afforded that opportunity for various number of reasons. But our system of government is absolutely genius in how it was set up. I cannot believe how many things that the Founding Fathers thought about so many years in advance. I'd hate to see it structurally change too much. Can you tell me another country you'd rather be in than the United States of America?
Absolutely not. In fact, I made a statement the other day. I was talking to a group of people, and I said, if there's anywhere I would rather be right now than where I live in eastern North Carolina, with everything from sweet potatoes to pork, I don't know where it would be. I couldn't pick a place on the globe.
Well, I love Sampson County, but the only place I'd rather go, if I could turn the clock back to 1980, Warsaw, North Carolina, would be Clinton.
That's it.
Yeah.
As we look at these things, and we're coming up on ending the show here, last minute comment or thought?
Again, I think there's going to be tough sledding ahead. We're not going to have a structured rollout. I do hope. I tend to favor more personal choice. I hope Governor Cooper will allow us to go ahead and have not a one-size-fits-all solution, but maybe a regional rollout where restaurants are able to open if they don't have the number of cases. And I'm scared that a limited seating capacity is going to set somebody up for failure. And I just think when you look at the throughput some of these businesses have to be sustainable and to make money, and making money is not a dirty word, folks. You have to have it to stay in business. That we're setting some of these businesses up for failure. And so I'm fearful, at least short term, that we're going to have some business failures and bankruptcy. I was seeing, JCPenney may file bankruptcy today. They probably already have. They were on teetering before this, but we're not going to have a V-shaped recovery most likely. And I would just say, stay the path if you're young enough and can handle it.
Thank you for being with us, Michael. Michael is a shareholder with Black, Chestnutt, and Johnson, PA, right here in Clinton. If they need to get up with you, they can call you. Ladies and gentlemen, we thank you for being with us. We look forward to seeing you again next week. And as always, we like to look at this show that we're bringing you some information, education you can use. Keep emailing us at weshouldknowedu@gmail.com. We look forward to seeing you again week.
Thank you for tuning in to this week's episode of We Should Know with host J.W. Simmons. If you have a question, comment, or suggestion regarding this or any episode, please send your emails to weshouldknowedu@gmail.com. And remember to tune in every Tuesday at 2:30 for another informative episode of We Should Know.